Now speaking, Isabel Jancy, Vice President, Investor Relations and Treasurer. Home Depot's first quarter 2023 earnings call was held with Ted Decker, Chair, President and CEO, Billy Bastek, Executive Vice President of Merchandising, Anne-Marie Campbell, Executive Vice President of U.S. Stores and International Operations, and Richard McPhail, Executive Vice President and Chief Financial Officer present. The call was open for questions from analysts and investors, who were asked to limit themselves to one question and one follow-up. Forward-looking statements and non-GA. Now speaking, Ted Decker, Chairman, President, and Chief Executive Officer. Over the past 3 years, the Home Depot's business grew 43% to a total of $47 billion. However, sales for the first quarter of fiscal 2023 were $37.3 billion, 4.2% lower than the same period last year. Comp sales declined 4.5%, while diluted earnings per share decreased to $3.82 compared to $4.09 in the same quarter last year. Factors contributing to the underperformance included lumber deflation and unfavorable weather conditions, particularly in the Western Division. As a result, the company expects comp sales declines between 2 to 5% and operating margin rate between 14.3 to 14%, with EPS declining 7 to 13%. The Home Depot remains optimistic in the medium to long-term outlook for home improvement and their ability to grow market share. They will discuss more opportunities at their Investor and Analyst Conference on June 13. Now speaking, Billy Bastek, Executive Vice President, Merchandising. In the first quarter of 2022, sales were below expectations due to lumber deflation and unfavorable weather. 4 of 14 merchandising departments posted positive comps. Average ticket increased 0.2%, while transactions decreased 5%. Deflation from core commodity categories negatively impacted average ticket by 335 basis points due to a 64% decline in framing lumber prices. Total company online sales decreased 2.9%, with 45% of orders fulfilled through stores. Big-ticket comp transactions were down 6.5%. DIY customers outperformed pros, but both were negative due to lumber deflation and wet start to spring. In March, there was a year-over-year improvement in attrition rates, leading to improvements in customer service metrics and safety incidents. To improve order fulfillment process, hours were allocated more accurately based on product type, and orders were grouped in batches. Sidekick app has improved shelf availability 300 basis points and drove higher value tasks. Now speaking, Richard McPhail, Executive Vice President, Chief Financial Officer. In the first quarter of fiscal 2023, total sales were $37.3 billion, a 4.2% decrease from last year. Comps were minus 4.5%, with U.S. comps at minus 4.6%. Gross margin was 33.7%, down 8 basis points from last year. Operating expense increased 25 basis points to 18.8%, and operating margin was 14.9%. Interest and other expenses for the quarter totaled $441 million, up $72 million. Effective tax rate was 24.2%, and diluted earnings per share were $3.82, down 6.6%. We opened 2 new stores, bringing our total store count to 2,324, and merchandise inventories were flat at $25.4 billion. We invested approximately $900 million back into the business in the form of capital expenditures, paid approximately $2.1 billion in dividends, and returned approximately $3 billion to shareholders via share repurchases. Our return on invested capital was 43.6%, down from 45.3% in the first quarter of last year. Going forward, we expect sales and comps to decline between 2 to 5%, targeting an operating margin of 14.3% to 14%, an effective tax rate of 24.5%, interest expense of $1.8 billion, and a 7 to 13% decline in diluted EPS compared to fiscal 2022. J.P. Morgan Chase & Company analyst Chris Horvers inquired, "I saw that the average ticket was flat in the first quarter compared to the same SKU inflation of around high single digits throughout last year. How much of the reduction in ticket deceleration from 1Q last year was due to disinflation on a year-over-year basis versus?" Ted Decker replied, "Chris, good morning. Inflation is still present in 2023 with non-commodity items, such as our average ticket, lapping up costs and price from last year. We are still seeing inflation in same SKU items despite the example of lumber being down 64%. There is still." J.P. Morgan Chase & Company analyst Chris Horvers inquired, how much of a headwind have I incorporated into my guidance due to the 37% uptick in ticket size in Q1 2021 compared to Q1 2019, with roughly a third of the increase being attributed to same SKU sales. Additionally, what risks exist due to disinflation and possible trade downs in project size? Ted Decker replied, we have seen a lot of cumulative inflation in our average unit retail and ticket prices over the past 3 years, but we are not expecting these prices to broadly deflate. We will adjust commodity prices, such as those for battery-powered outdoor power equipment and paint, on a weekly basis. The higher ticket prices include innovation trading up to better products, so we don't anticipate broad. J.P. Morgan Chase & Company analyst Chris Horvers inquired, do you think project size will cause ticket sales to decrease over the year? Ted Decker replied, over the past few quarters, we have observed two main factors impacting ticket and transaction size. Discretionary items such as grills, patio sets and appliances have experienced pressure for some time. Additionally, while pro-project backlog is still elevated, projects are getting smaller in size, which affects items per basket and overall activity. Citi analyst Steven Zacconi inquired, have you seen any effects from the volatile weather in the U.S. during the second quarter and how can we expect it to affect the full-year guidance range? Richard McPhail replied, in the first 2 weeks of May, performance was in line with our guidance. We expect to learn more in the next few weeks about underlying demand as our largest selling weeks are still ahead. Our range of -2% to -5% reflects a 120 basis points comp pressure in Q2 due to lumber and our share of PCE shifting at a higher rate than expected in Q1 and holding that rate for the rest of the year. In the -2 case, we expect the second half of the year to be better than the first due to normalization of lumber. In the lower end of the range, we anticipate the first half will outperform the second due to continued acceleration of our share of PCE. Citi analyst Steven Zacconi inquired, can you provide an outlook for the trajectory of demand for home improvement, both in terms of 2020 as a potential trough and any changes that may occur in 2024? Is there anything you can share ahead of Analyst Day next month? Ted Decker replied, the consumer is still strong with personal consumption increasing, and customers are healthier than the overall consumer with good jobs and increasing wages. Home values have increased by $15 trillion since 2019, resulting in growth of $47 billion and 43% cumulative comp for home improvement. Consumers have shifted their spending into home improvement and PCE normalization may suggest that it stays elevated. It is a large and fragmented market with tremendous growth opportunities. Citi analyst Steven Zacconi inquired, did I mention how appreciative I am of the detail provided and wish you the Wells Fargo securities analyst Zach Fodham inquired, have we seen our EBIT margins decrease from 15.3% last year to 14.3% today? How does gross margin and SG&A factor in? Additionally, what was the impact of the legal settlement on our cost controls during Q1 and are there any other? Richard McPhail replied, I answered a question about our operating margin in 2022. We originally guided for 14.5%, but due to natural deleverage in the business, a $1 billion investment in wages, and productivity initiatives, we revised our guidance to a range of 14.3% to 14.0%. There is a natural buffer from our activity-based payroll model, and we will protect 14% operating margin. We also received a one-time legal settlement benefit which we assume will be offset over the rest of the year. We are operating with financial flexibility and will evaluate available levers against the backdrop of the environment. Wells Fargo securities analyst Zach Fodham inquired, do macro and housing indicators have an impact on your business today? What effect, if any, has the availability of sub-3% mortgages had on housing turnover recovery? Richard McPhail replied, we have seen the impact of higher mortgage rates on housing turnover, with 40% of occupied homes owned outright and 90% of those with mortgages having a fixed rate under 5%. In February, our business was trending positively, however in March, extreme weather and tighter credit conditions due to external factors such as the collapse of SVB caused a shift in consumer caution. UBS analyst Michael Lasser inquired, have product categories such as appliances, grills and patio furniture been selling more units than in 2019, and what does this suggest about the potential for a downward comparison scenario? Ted Decker replied, Michael asked a great question about the level of detail by category in retail sales. Patio grills, appliances and building materials have seen increased demand in units with innovation and outsized demand. Prices are coming down for lumber and it has led to increased unit volume and the highest ever attach rate to hardware products. Billy Bastek replied, I saw great performance in our building materials and lumber business, with good unit productivity, along with smaller projects taking place. There was a pull forward in some of the businesses initially discussed. UBS analyst Michael Lasser inquired, will the Home Depot start to see leverage on expenses with the first dollar of growth in 2024, or will there be some catch-up items such as legal expense and incentive comps that will need to be addressed first? Ted Decker replied, at our June investor conference, we will provide more details about our outlook for 2024. At this time we are only a few months into 2023, so we are not modeling out to that level of specificity yet. We plan to leverage volume to reduce product and transportation costs associated with COVID-19. Additionally, our store and labor expenses should decrease as our business grows. Richard McPhail replied, I manage cost and price independently from transportation costs, which fluctuate in the market. I will advocate for value with respect to price, and we can discuss this further on June 13. UBS analyst Michael Lasser inquired, can I just clarify, does Home Depot expect to see like-for-like product deflation in non-commodity related areas this year due to lower transportation costs and raw materials, or will they advocate for growth and value? Richard McPhail replied, I manage cost and price independently and do not anticipate broad-based deflation in the market. Oppenheimer and Company analyst Brian Nagel inquired, have you seen any difference in comps between markets where weather impacted sales versus those where weather was more normal? Now that spring has arrived, have you noticed an increase in seasonal categories? Ted Decker replied, thanks Brian. Weather was most pronounced in the West, resulting in record rain and even snow in Southern California. Compared to our northern and southern divisions, the impact of the weather was multiple times worse in the West. The bathtub effect, where people make up for lost sales during a short spring season, is more typical in the North. In the West, however, due to large stores and high concentration of pro customers, bad weather results in lost selling weeks that can't be made up. Despite this, sales were strong on the few good weekends in the North. We hope for better weather in Q2. Oppenheimer and Company analyst Brian Nagel inquired, do you anticipate that the updated guidance for 2023 will remain consistent with the current progress in 2023, or are you expecting improvement/deterioration later in the year? Richard McPhail replied, we gave a range of -2 to 2 due to the possibility of accelerated reversion to 2019 levels of share of PCE by the end of the year. This was based on a hypothetical case we laid out at the start of the year, which took into account the sharper than expected reversion in Q1. Truist Securities analyst Scott Ciccarelli inquired, have you been able to protect the 14% operating margin despite investing in wages this year? What flexibility do you have on SG&A considering labor is your biggest expense and you're investing more instead of less? Richard McPhail replied, we have invested an additional $1 billion in wages, which has proven to positively impact customer experience. This is reflected in our guidance and margins. We are comfortable with the level of investment as it stands today but will assess and adapt accordingly based on the environment. We are committed to investing to win in the long run. Truist Securities analyst Scott Ciccarelli inquired, do higher interest rates alter our capital allocation strategy, specifically our level of aggressiveness when it comes to issuing debt to buy back stock? Richard McPhail replied, we successfully repaid a $1 billion debt maturity in April without refinancing, so we feel confident about our leverage position. We currently have no need to access the debt capital markets and will monitor market conditions going forward. KeyBank Capital Markets analyst Brad Thomas inquired, have the pro-business trends improved as the weather has become better? Is there a different outlook for the pro-business going forward compared to its recent underperformance in comparison with DIY? Ted Decker replied, I've seen a disproportionate impact from lumber on the pro, but there is a strong pro-business environment in the West. Our customers have been engaging positively with our capabilities, which we are pleased about. Executive Vice President, Outside Sales and Service Hector Padilla inquired, have we seen positive performance on a 2-year basis? What are pros engaging with in terms of our supply chain and capabilities? Are pros consolidating their purchases with the Home Depot, and is this reflected across many markets? Can I look forward to speaking with you in June to discuss the pro business and our capabilities? KeyBank Capital Markets analyst Brad Thomas inquired, have you revised your outlook for the home improvement market, given weather and deflation? Was it previously predicted to decline by low single digits? Richard McPhail replied, at the start of the year, the outlook for personal consumption expenditure, PCE, was flat. However, some economists have raised their expectations for PCE slightly. Despite this, our market is expected to be down mid to high single digits and we expect to gain market share. Morgan Stanley analyst Simeon Gutman inquired, have demand and turnover decoupled, leading to home prices mattering more? Could this potentially result in the back half of the year being worse if strictly adhering to prices, as there may be a lag effect? Ted Decker replied, home value has the tightest correlation to home improvement spend in comparison to other housing metrics such as turnover and household formation. There is often a lag effect when it comes to home price appreciation or depreciation, but people are still sensitive to changes in home values. From the end of 2019 to now, home values have increased by 45%, though month-over-month they may be decreasing slightly. Consumer apprehension due to inflation. Morgan Stanley analyst Simeon Gutman inquired, have I understood correctly that the midpoint of -2 to -5 assumes the core business will worsen from Q1 and lumber market conditions will also worsen from Q1? Richard McPhail replied, lumber had a 120 basis points of pressure on Q2 and slight, non-meaningful pressure in the second half. We provided a range view of guidance due to the early stage of the year, making it difficult to extrapolate. Barclays analyst Seth Sigman inquired, have we seen prior cycles where home improvement wallet share goes lower than 2019 levels? What is the likelihood of that scenario happening this time considering the potential for pull forward? Ted Decker replied, we anticipate 2023 to be our best year yet, however if we revert to 2019 levels by the end of the year it could have a hangover effect into 2024. We don't know if it will overshoot but there is a strong case that it could settle at a higher rate. The average age of homes is now 40 years old, with many reaching their 20 and 40-year markers, resulting in increased wear and tear. With more time spent at home, this could mean our spending settles out potentially higher. Barclays analyst Seth Sigman inquired, do the underlying EBIT margins for this year reflect a lower margin than the 14% guidance, considering the Q1 SG&A benefit and any offset you mentioned? Richard McPhail replied, I asked a question and received clarification that the gain would not be assumed to be lower, but offset through the remainder of the year. Guggenheim Partners analyst Stephen Forbes inquired, have lumber prices decreased during this quarter and what is the expected unit volume for the second half of the year? Billy Bastek replied, anticipate greatest pressure from lumber in first half of year with estimated deflation impact of 100 basis points. In Q1 saw 220 basis points and 120 basis points in Q2. No material impact from lumber in back half of year but still seeing strong unit performance in the category. Guggenheim Partners analyst Stephen Forbes inquired, do you anticipate an increase in unit volume for lumber in the second half of the year? Billy Bastek replied, I have seen that the pricing has been gradually normalizing year over year, and I expect this to continue as we return to the level of rationality observed in the second half of 2019. Guggenheim Partners analyst Stephen Forbes inquired, can I get a preview of what will be discussed at the upcoming Analyst Day? Specifically, can you provide more information about your comment about 2024? Isabel Jancy replied, I'm excited to talk about the updated total addressable market, TAM, for our business, as well as discuss potential growth opportunities in the sector. Isabel Jancy replied, I would like to thank Christine and everyone for joining us today. We are excited to host our investor conference on June 13th.